How to raise capital the unconventional way. Super niche methods you've probably never tried. Raising capital is often reduced to a predictable list: venture capital, angel investors, crowdfunding, bank loans, grants. But what if you don't fit into these boxes, or simply don't want to? Below are deeply unconventional, niche ways to raise capital that rarely make it into startup handbooks. 1. Domain flipping for seed capital. What it is: buy undervalued domain names and resell them to the right buyer. With $50 to $500, you can acquire multiple high-potential domains and sell them for 10x or more. Why it works. Businesses are always on the hunt for brandable domains. A good flip can net thousands within weeks. It's low barrier, skill-based, and doesn't dilute equity. Pro tip: use tools like expireddomains.net, NameBio, and BrandBucket to scout domains and predict value. Pair this with outbound outreach. 2. Capital from content licensing. What it is: create niche content, a viral video, infographic, code base, white paper, poem, and license it to companies, creators, or media outlets. Why it works. Original IP, even small pieces, can generate revenue through reuse, citations, or syndication, especially in B2B or media industries. Example: a founder created a viral mental health infographic. It got licensed by a wellness startup for $3,000 to use in their campaign. 3. Micro-acquisition arbitrage. What it is: buy tiny, low-maintenance online businesses like newsletter lists, ebooks, or single-product Shopify stores, optimize revenue, and use the profit to fund your main startup. Why it works. These digital assets are often undervalued and can provide cash flow with minimal effort. Platforms like MicroAcquire, Flipper, and Indamaker have a goldmine of underpriced assets. 4. Use strategic barter instead of capital. What it is: trade your skills, services, or equity directly for things you'd normally need money to buy: ads, office space, legal help, even software licenses. Why it works. Eliminates the need for cash by converting your value into usable assets. You keep ownership while reducing burn. Real use case: a startup traded 1% equity with a top Nigerian growth hacker for 3 months of performance marketing. Equivalent value: $15,000 plus in save costs. 5. Get paid to validate. What it is: turn your MVP validation process into a paid offering. Offer workshops, mini courses, or reports to your target users while still developing your core product. Why it works. You're generating revenue while building and getting early adopters on board. Many niche B2B startups bootstrap this way. 6. Sell digital futures, aka pre-product licensing. What it is: offer future lifetime access to your yet-to-launch product at a discounted rate before it's built. Why it works. This isn't a Kickstarter-style campaign. It's a direct sale to specific people or companies who trust you and need what you're building. Example: a SaaS founder raised $18,000 by selling 10 future lifetime accounts at $1,800 each to LinkedIn contacts who needed his AI calendar scheduler. 7. Niche government bounties and hackathons. What it is: many governments, NGOs, and international orgs, especially in Africa, run small innovation challenges with grants or awards. Think local, not just national. Why it works. Less competition. These programs are usually undermarketed and willing to support novel ideas that target real community needs. Where to look. Check City Council websites, UN development programs, DFID, GIZ, and World Bank Challenge portals. 8. Run paid industry experiments. What it is: offer to run a small, controlled experiment for a brand or institution that aligns with your target market. In return, they fund your setup or pay for insights. Why it works. You turn market research into a service. It helps you validate your product while getting cash flow. Use case: a founder in Lagos got a telecoms company to pay 1 million Nigerian nairas to pilot a WhatsApp, but he was building for youth engagement. 9. IP leasing or revenue share deals. What it is: license your software, content, or idea to another company in exchange for % of revenue or fixed monthly fee. Why it works. You earn passive capital while still owning your idea. especially good if you have code or content not being used. 10. Collective capital circles. What it is: form a private funding syndicate among peers. Each person contributes a fixed amount monthly. You take turns using the pool to fund the project. Why it works: low-pressure way to raise without outsiders. Can work within communities, co-working hubs, churches, or alumni networks. Caution: requires deep trust and legal clarity. Treat it like a rotating savings and investment club. Final thoughts. The key to unconventional capital raising is understanding that money follows attention, leverage, and originality, not just investor decks. If you're creative, good at spotting arbitrage, and willing to trade value creatively, you can bootstrap your startup far beyond what traditional capital routes allow. Let your capital raising strategy be as innovative as your product.